Hello, this is Edmund Shing from BCS Asset Management. Today we're going to look at bond yields and why bond-sensitive investments are still a good idea. So, we are going to look at, as I said, the current state of bond markets. We're also going to look at bond-sensitive investments such as Build America bonds and preferred shares, and we'll come to some conclusion as to what to hold. Here we're going to look at bond markets, government bond markets as they are today. Here we have the US long government bond ETF, TLT. As you can see, in general, it's been going up. And yes, it did pull back 5%, but remains in an uptrend. That is the key point. It remains in an uptrend, which remains bullish for bonds. If we look here to the European government bond market, we can see again a very strong bullish trend, which has been in place since the end of 2011 and is still in place today. So just looking at government bond markets in Europe and the US, we would say that the current medium-term and long-term trends are still positive, suggesting advances for bonds and lower bond yields ahead. So, what can we do? If we look at central banks, this is the ECB, we can see that the new targeted long-term refinancing operation was actually very small at less than 83 billion euros out of a potential maximum of 400 billion euros. This was done in September, but remember there is a second tranche of TLTRO operations coming in December. So it may well be that this first tranche of lending by the ECB has been disappointingly small, but we could see much more coming in December. If we look at the ECB's balance sheet here on page 8, we can see that it has shrunk by some 35% since peak in mid-2012. In other words, with the first rounds of long-term refinancing operations, very cheap money lent out by the ECB, most of it has already been repaid by European banks to the ECB, which is why its balance sheet has shrunk. That's why the ECB needs to do more to expand their balance sheet to try to support the European economy, because there is a lack of demand for credit right now. And there we can see. If we look to the US, in contrast, the Federal Reserve's balance sheet continues to grow as it continues, despite tapering, to provide support to the economy by buying US government bonds. Now, let's look at why inflation isn't going to come back. Here on page 11, we have the US labor participation rate. And as you can see, since the year 2000, it has dropped by 4.5 percentage points to a new historic low of 62.8. So fewer people are trying to find a job or are in a job. A lot of people have simply left the labour force and have given up. Equally, underemployment in the US, and this is the black line here on the chart on page 12, is still at a very high 12%. Yes, it has come down from the peak of 17%, but at 12%, it is still very high. In fact, as you can see there, it's well above the peak of 10% that was seen in the last recession in 2003. If we look at underemployment in the UK, as an example, we see something interesting. Despite the fact that the unemployment rate has come down in the UK, the underemployment rate, looking at these statistics every 2 years in the UK, have actually gone up as of March of this year. So underemployment is a big problem in the US and in the UK and Europe, suggesting that there is little chance of seeing wage inflation. And indeed, here on page 14, when you look at global inflation rates, apart from Japan, where they had an increase in sales tax, which has temporarily seen inflation rates go up, elsewhere, such as the US, China, Japan, and Europe, has seen inflation rates on average come down over the last few years, and there has been no change in that trend yet. So, let's look at a few bond-sensitive investments. One that we have in the Global Mega Themes Fund that I still like is the Cohen and Steers Total Return Realty Fund. This invests in real estate. And as you can see, in the long term, over the last 15 years, it has vastly outperformed the S&P 500 index, producing an annual return of nearly 10% versus only 5%, including dividends for the S&P. Equally well, you can see on this chart the black line, which are preferred shares. The Nuveen Quality Preferred Income Fund has also done much better than bonds. Both the Cohen & Steers Realty Fund and this Nuveen Preferred Fund have both outperformed long-term government bonds by a very wide margin, by 10 to 11% per year over the last, nearly 3 years now. Another holding that we have, which is bond sensitive, is the Duff and Phelps Global Utility Fund, shown in black on this chart on page 18. Here again, you can see not only has this outperformed vastly long US government bonds, which are the dotted line at the bottom, but also it has outperformed dividend growth funds, such as the Vanguard Dividend Appreciation ETF, the red line. So utilities have done even better and should continue to deliver a better total return given the high dividend yields that are on offer from this fund. And again here you can see BBN, which is the BlackRock Build America Bond Fund in black, again done far better than either investment grade bonds or the total bond market ETF, which are the two dotted lines underneath. So again, Build America bonds, another big holding in the global mega themes fund, we still see has potential. So to sum up, we think that it's not yet time to give up on the bond market. We think that there is further potential ahead, even into 2015, because the ECB, for one thing, needs to launch a second tranche of targeted long-term refinancing operations, whereas the Fed will not be raising rates until into 2015. And so we would highly recommend investments, as we have done, in Build America bonds, in preferred shares, and in real estate. This is Edmund Shing saying goodbye.